Hello and welcome to this week's short strategy tutorial with me, David Jones, and Trading 212. Over the course of the next few minutes, we're going to take a look at the idea behind the oscillator known as the slow stochastic. What goes into it, how it's calculated, how it's meant to work, and how does it work in the real world. It's a momentum oscillator, so it belongs to the same sort of group as the RSI, the relative strength index that we've covered before. But I think some people would think it maybe gives more reliable signals than the RSI because there's an element of smoothing that goes in to the slow stochastic. You can make up your own mind and see whether it would fit with your own trading. As with all of this stuff, there's no magic holy grail. There's not one approach that works all the time. But let's get started and take a look at the theory behind the slow stochastic and how it actually worked on a real market. So as usual, let's start with our theoretical market. So the blue line here, this is the market, whatever market it is, whether it's a currency, a commodity, share. And down here we have the slow stochastics lines plotted in green and red. Now, let's take a step back and just explain how each of these lines gets calculated. The first thing we have with the slow stochastic is a value known as percentage K. I think the best way of thinking about this is almost like an RSI. It's something that calculates how extreme the market is compared to how it's been moving. So if we have a 5-day percentage K, it looks at the last 5 days, and if the reading is 80%, 90%, something like that, it's suggesting the market is at the top of its range. But neither of these lines is percentage K. The first line that gets plotted is a line called percentage D, and percentage D is a moving average of percentage K. So it's taking the value here every day and trying to smooth it out. So it's trying to make it a bit more reliable. The second line we have plotted is a line called percentage DN, and percentage DN is a moving average of that moving average there. So everything starts off with percentage K. That's where the raw calculation is done. But when it comes to the lines that are plotted, in this example here, percentage D is the green line, a moving average of percentage K, and then the red line here is percentage DN, which is a moving average of the moving average. When it comes to values, there are some common values. So typically a 5-day slow stochastic will have 5 for percentage K, 3 for percentage D, and 3 for percentage DN. For those looking at something a bit more longer term, not drastically longer term, we can have a value of 10 for percentage K, 6 for percentage D, and 6 for percentage DN. And the way the signals get generated, you'll remember a few vlogs back, we talked about moving averages and about the price crossing through the moving average. With slow stochastics, it's when the quicker line, percentage D, crosses over the slower line, percentage DN. So here, for example, that's a buy signal when they're oversold and crossover. Up here, the market rallies, drags the two slow stochastics lines up. The market starts to turn. The slow stochastics turn over as well. So this signal here, that's a sell signal. Down here, the crossover is a buy, and so it goes on. Another signal there, and one last signal there. So that's the theory. That's how it's made up, and that's how it will look on your chart. Let's take a look at it in the real world. Okay, let's take a look then on a real market. We've got here the price of oil. This is US oil, daily candlestick chart that we're looking at going back to August 2016. So let's choose our indicator. So we're going to go up here to indicators. It's an oscillator, the slow stochastic, so we're going to scroll down and pick it out of the list here. Here we go, the slow stochastic oscillator. So we'll click on that. I'm going to go for the longer term one. So 10 is the value I'm going to put in. 6. So I would refer to this as percentage D. On the software it's showing as slow K, same thing, different name. And then over here, which I refer to in the textbooks, we refer to as percentage DN. It's known as D on here. But again, what we're looking at, K is the raw value, then we're smoothing that out. So we've got a 10, 6, 6 stochastic. So we're now ready to go. Click on confirm, and there are our lines. Let me just drag this up so we can see a bit more of the stochastic and compare it to how it's done with the moves in oil. Let me just walk through some of the signals. So back here, we had a signal here where you can see the quicker line, the quicker moving average crossing through, the slower, giving us a buy signal. It was okay, the market went sideways really, but then I suppose if you'd have wanted to, you could have taken that signal there where the market finally got moving. Then up here you can see the market rallies. So of course the two stochastic lines get dragged up as well. The market pauses and then starts to roll over, and there's our sell signal. So the market did push a little bit higher, pushed from 51.60 up to about 52.18, so about 50 cents higher, but that signal I think was a pretty good one. Market sells off back below the 44 mark, stochastics get dragged down, buy signal in here, again maybe a little bit early, 4 days early. The market drifted a little bit, but overall did end up rallying away. Then it gets really messy, and this is, I'm glad this bit is in here because it shows that this isn't a magic system. There is no magic system that works all the time. So we had a sell signal there, not very good. A sell signal there, a bit better, but the market just went sideways. I wouldn't say this was a valid buy signal because the market didn't go below this oversold, below the 20% mark there. Probably the next best signal we have, or the next valid signal, is up here, the 22nd of February, where the market hits those old highs again, sort of in the $55 a barrel area. The stochastics roll over again. Down here we have a buy signal, again a little bit early, maybe a week too early. The market drifts off a little bit, not drastically. Another unwinds, give us another buy signal there. Sell signal there. Buy signal down there, again a bit early, but eventually the market did rally. A sell signal up there. So the last signal we had was the 23rd of May on the daily chart. Of course, you can apply this to shorter term charts if you want, but I think for the purposes of this example, I'll just stick with a longer term chart. So we have a sell signal there. And as of the end of last week, we're almost on the verge of getting a buy signal on our 10.66 slow stochastic. So it's not perfect, but I think in conjunction with other approaches, trends, support and resistors, and sensible stop losses, maybe it can add something to your trading when it comes helping you pick out some of these turning points in the market. That's it, that's the slow stochastic. Maybe it will be useful for your own trading. You might want to add it to your charts and see how it works. I'll be back in a week with another short tutorial. To make sure you don't miss out on any of these, if you click on subscribe, you'll get notified whenever the next one gets uploaded. If you like the video, just click on the thumbs up down below. And as usual, if you have any questions or stuff you'd like us to cover in the future, just leave us a message in those comments down below. But for this week, from me, David Jones and Trading 212, we'll wrap things up there, and I hope you have a good trading week.